One of the challenges for a company like Virgin Galactic is going into a downward spiral where the stock starts to decline. That reduces the company's ability to raise new capital, whether it's debt or equity or any other kind of capital raise. That makes it more difficult to get to the point where they're going to actually generate positive free cash flow and on and on. Ironically, a falling stock price for a company like this can actually lead to the company's demise, but the opposite is also true. If the stock price rises, then there are more options available for raising capital, and you can increase your runway and the number of spacecraft that can be built. So, one of the things that I think is interesting at the end of 2023, as we look forward to 2024, and the company's future over the next couple of years, where they're not going to have any space flights, they're going to be building out this Delta class space of rockets, is how important the rise in the stock price recently has been and how that could potentially lead to further rises in that price over the long period of time. So I want to go through some of those details today and tell exactly what I'm seeing and looking for from Virgin Galactic over the next few months. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And let's go to the stock chart because I think the increase since earlier in the fall is really critical for Virgin Galactic. This is a look at Virgin Galactic's stock chart over the last 6 months, and you can see that shares are down 57%. But if we look at the stock's return since November 8th, shares are up 65%. So we're now up to $2.58 per share, market cap of a little over $1 billion. That's still lower than the company's cash on the balance sheet at the end of the last quarter, which was $1.1 billion. So right here in this period, you actually had a pretty good risk return for the company. But what happened on November 8th is the company announced their third quarter earnings results, and they gave a plan to get to free cash flow positive about 3 years from now. What investors want to think about is how long is the runway for the company? Are they going to be able to invest in the business, in developing that Delta class spacecraft, paying for operational costs, and then actually building enough spacecraft to be able to get to cash flow positive? So let's go through a few of those numbers because as the company stands today, they say they can get to positive free cash flow, but it's a really tight rope that they're walking right now. And this is why the increase in the stock price could be important, could allow the company to raise capital at a much better valuation. This is a look at the most important chart from the earnings release where management gave a path to cash flow positive operations. In 2026 is what they're saying. I'll explain a few things here. What they're going to do is they're going to basically eliminate a lot of their spacecraft operations. They're going to shut down space flights in mid-2024, reduce costs as much as they can in those spaceline operations. That's what this purple line is here. But they're going to continue developing the Delta spacecraft. That's that next generation spacecraft, going to go from 4 seats for passengers to 6 seats for passengers, going to be able to fly as much as 2 times per week. I'll get to the economics of the Delta spacecraft in just a second. But that's what this gray segment is here. They're going to increase their capital expenditures, which is both the design and then build out of these spacecraft. And what we have here is the expected cash flows. So this is cash inflow from flight, the dark purple line, and the bottom is the expenses. And what they're expecting is to be cash flow positive as early as 2026. This is assuming there's going to be 2 spacecraft built. So the tightrope that they're walking is that 2026 is going to be cash flow positive, but these 2 years right here are really important. So as of the third quarter of 2023, the company had $1.1 billion in cash. The ongoing run rate of expenses is about $500 million, $450 to $500 million. That is going to reduce on the operating expense side, but a pick up on the capital expense side because you have to build out these spacecraft. So they didn't give detailed numbers, but based on the cost reductions, we can expect that they have about $1 billion in planned expenses between now and the end of 2025. That should be about the range that we're thinking about. Maybe it's a little bit less than that, but then you've got to get to ramping up operations in 2026. So like I said, this is a very tightrope that the company is operating. These spacecraft are not cheap. It says right here, $50 to $60 million to build. So that only leaves you $1 billion to do all of the capital expenses, continue running your operations, to continue as an ongoing business. Even running the flights that are going to be taking place in early 2024 are going to be relatively expensive. But the economics, if they can get to this point, get to operations where there's a number of spacecrafts flying multiple times per week, that's when the company gets really compelling. This is the unit economics for the Delta class spacecraft. There are a few things that have changed over the last few months. One is that they doubled the flights per month from once a week to 2 times per week. So 8 flights per month. And they're also expecting revenue of between $2.7 and $3.6 million. This will be a little bit lower early on because a lot of the people who are early on the list are going to be paying a lot less than that. But on an ongoing basis, we're probably going to be somewhere in this $2.7 to $3.6 million range based on a $450,000 flight ticket. So that leaves you with monthly revenue per ship of $21.6 to $28.8 million. So if you have 2 ships, you're looking at more like $50 million or so in revenue per month. This is also going to be very high margin because the cost to do each of these flights is not all that much, at least compared to the potential $2.7 million in revenue. I think a good proxy is about $2 million in margin that they're going to be bringing in on a per flight basis. So if you can do 8 of those flights per month, 2 ships, that's $30 million or so in margin. That would cover that $100 million in operating expenses that we talked about earlier on a quarterly basis. So this is where we're sitting from a financial perspective, both on the balance sheet and then the future potential for the business once Delta gets launched. The challenge is we got to get there. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So hopefully at this point, it's pretty clear what the potential is for Virgin Galactic if they can get Delta launched and get to 8 flights, 16 flights total on a per month basis. The challenge is actually doing that and executing on that vision because there's not a lot of leeway with that $1.1 billion in cash. I did a video recently based on comments that Richard Branson made. It doesn't sound like he's going to be interested in investing more in the company. So then the company's going to have to turn to public markets if it does need funds. And that's where the increase in the stock price is really important. If the runway today is 2 years and the ability to build out 2 spacecraft, and then they have to be operational at that point, it's possible that that's an absolute best case scenario. That the reality is that there's going to be a delay of 6 months, maybe even a year. So that would require another infusion of cash. If that infusion has to come when Virgin Galactic is desperate and is not anywhere near the point where it sees cash flow from operations, that's not the position that you want to be in as a business. So that's why I think this increase in the stock price is really important. We know that the company has sold about $400 million in shares in 2023. And I think we could see additional shares sold. And ultimately, long-term, that would actually be good for the stock. Yes, it would be great to do that at a higher price. But if by 6 months from now, the company has raised another $500 million, given themselves another year of runway, and maybe even the ability to build 3 spacecraft. So now you're, instead of doing 16 flights a month, you can do up to 24 flights a month. That could make that cash flow picture even better. So that's, I think, the ultimate upside for Virgin Galactic. And from a capital raise standpoint, I wouldn't be surprised if you see them going back to capital markets in early 2024, now that the stock price is a little bit higher, interest rates have come down. That would give the leeway the company needs, I think, to build out that Delta class spacecraft and not have to worry about where the stock is going. And then from an investment perspective, now we start to move from, is the company going to be able to survive the point of launching those Delta spacecraft, to what is it actually going to be worth when they do launch? And I think that's a much more compelling, bullish option for the company if it can get over this hurdle. So the market's reaction over the last few weeks has been really interesting. I find it positive the stock is up, and I wouldn't be surprised if management uses this to take some of those survival questions off the table in 2024, and that could be a great time to raise capital. But what do you think about the future of Virgin Galactic? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.